Good morning. Should be a short video today. I could really use your help with this one too. I think, like I said, I've been trying to wrap my head around this for a while. This is actually my second video on RYAM, and it's very interesting. I hope you enjoy it. So let's get started. First off, they're down 50% year to date. So that's immediately like really good to me, right? Because you're thinking that you might be getting it, being greedy when others are fearful type thing. What do they do? They are a chemical company that manufactures cellulose specialty products. They primarily have facilities, I think, here, Canada, and France. Here meaning the US. All right. What's interested me about them is two things. First of all, their market cap's 300 million. Their working capital is higher than that. So I'll just show you that real quick. Their working capital on the balance sheet, if I take current assets 662, so up here in the calculator, 662 minus current liabilities 321 minus 321, $340 million of working capital. Okay, so you have a chance here to potentially get something below working capital. The red flag's, of course, going to be the debt, which is the long-term debt, but we'll go into that. Another really interesting thing that caught my eye recently is the insider purchases. So this is Open Insider. It's great. It's free. You just type in a ticker and it tells you, all the insider transactions for that time period. All right. So these are all purchases as early as November last year, and then just continuing in May and then June this year as well. I mean, look at this. It looks like below $5 a share. Insiders are loading up. And this isn't small ads either. I mean, they're increasing their position by 60%, by 10%, 20%, 29%. So that is always a huge positive sign, right? So what I want to do is pull up their 10Q. We're going to go through the financials on the 10Q itself because I think a lot of this resides in the balance sheet. And then we'll kind of go from there. And like I said, I'd love to get your thoughts on it in the comments. Okay, so this is their most recent 10Q. I'm going to go to the income statement. Okay, yeah. So the big thing here is, where is it? Interest payment. Yeah, interest expense. $15 million for the quarter. Operating income was $16 million. Okay, so you're paying almost all of your operating income out into interest. So that huge red flag. If you've seen my checklist video, this would be flashing warning signs, So that's the big question. I think that's why the stock's depressed, is that everybody's scared of the debt, even though everything else seems okay. And you might be thinking, well, it's not just the debt, because they have so much interest payment, they're making no money. So they're making 2 cents or losing money on from an income standpoint. And you'd be right, except if you look at the cash flow, because first off, when I look at the balance sheet real quick, the property, plant, equipment is $1.1 billion. So they have a ton of heavy equipment and stuff that they're depreciating. I mean, you can see they started at $1.7 billion before depreciation, and now they're at 1.1. So what's happening, if you look at the cash flow, is that depreciation is getting added back in to from a cash perspective, right? Because it's not a real expense. So, I mean, look here. This is the cash flow statement. The depreciation add back is $35 million roughly per quarter, and that's going to be about the same every time, right? All right, so the big thing here is, look, are they CapExing more than they're depreciating? And the answer is no, right? If you look at capital expenditures here, it's 21 million per quarter. That's just the most recent quarter. It was 45 then. So, that would be the thing to look at, is like, how much money do I think, what's my free cash flow going to be? Not necessarily the income, because if you're getting a huge credit for depreciation, then it could be worth it. Okay, back to the balance sheet, because like I said, this is where I think it gets important. Current assets, like I said, 660 million. Current liabilities, 320. The big thing is this long-term debt, $800 million of long-term debt. Oof. Yeah, I mean, that's not fun. So what we're going to do is go down to the debt itself and look at it. When's it due? That sort of thing. What's the interest payment? So you scroll down here, you'll find it. Okay, here we go. Debt and finance leases. Okay, so the big chunk, there's two big chunks of change due, right? There's 2024 due at 5.5%, and then 2026 due, and that's $475 million due in 2026, and then a little over 300 million due in 2024. Okay, the rest of it is not significant compared to that, right? So the question is, are we in danger? Are we coming up on that, or that sort of thing? But I want to show you this news article that just came out in relation to these 2024 notes. I said just came out, and it was actually July 20th, and it's not a news article. It was a press release. Okay, so they refinanced their 2024 notes by going in debt of 250, or I'm sorry, yeah, they refinanced the 2024 notes, that 320 that we saw, with roughly 250 million of debt, and then they're using 85 million in balance sheet cash to redeem the 318 million. So that's really good. I mean, they're retiring in essence $85 million of debt, and then putting off the I guess balloon payment, you'd call it, till 2027. I mean, expiration date. So instead of being due in 2024, now it's due in 2027. I don't think interest rate's going to be changed. The reason is that, where was it? They mentioned something. Okay, yeah, here it is. We were able to partially offset the impact of higher interest rates by reducing our overall debt balance. So in a way, they're saying interest is going to be pretty much unchanged, maybe even a little bit higher, but you don't have those notes due for some time, right? All right, so let's go back to that 10Q, and you can see that this 317 is now going to be 250, and it's not going to be due until 2027. So your next thing that they got to worry about is 2026. Okay, so that's interesting. Next, I want to show you the capital allocation policy, because I love this. They have their, priorities listed, which is something I love to see in a management presentation. Like, tell me what you're planning to do with the capital, or else if you don't have a plan, then it's just going to kind of disappear, right? It's like having a budget at your house. All right, so prudent balance sheet, number one. Okay, that's awesome. That makes me excited that that's their number one priority. They acknowledge that, hey, look, we want to reduce the debt. They've actually reduced it a ton since I've been following them. They're at 60. They've had a 67% reduction in net leverage. And I remember whenever they sold their pulp and paper, or not pulp, whenever they sold their paper mill or wood, whatever you call it, their forest thing, for $230 million. Next is stabilize operations and reinvest in the business. That's standard, right? I mean, that makes sense. What I really like is this, the order of these two: return capital to shareholders before strategic investments. One of my favorite Warren Buffett quotes is that strategic investments just mean that they paid too much. So if the numbers don't quite work for something, if it's not really a good investment, they'll say, well, it's just strategic. And just as far as the return capital to shareholders, they suspended the dividends. Well, that was smart because you have so much debt. And then no share repurchases except the stock repurchase to satisfy tax requirements. All right, let's go back to the financial history and then just kind of maybe get a valuation. So this is what I want to do for the valuation. I want to create a scenario. Let's say that you make net zero income on paper. So everything that you make kind of gets wiped out by the interest payment and the depreciation, right? But from a cash flow perspective, in operating cash flow, you're going to make exactly that depreciation back. So let's say $35 million a quarter. So $35 million a quarter times 4. All right, so $140 million a year in cash from operations. That's what you're going to make. And this is hypothetical, right? And then you need to CapEx, let's say 2/3 of that to keep the plants in good shape, and that sort of thing. Okay, and it's actually, I think they've actually CapEx less than that. So yeah, they've capped. No, it's been about that. Okay, so anyway, if I multiply this by 0.333, that's what's left, right? Because if you're CapExing 2/3, then you're left with 1/3 of free cash flow. So in a way, you'd be generating in this scenario $46 million of free cash flow per year. That's pretty good for a market cap of 300 million, right? The big question mark is that debt. What happens if the market turns around and now they're not making that much money and they need to do these interest payments? I mean, they do have some cash on the balance sheet, so there's that. But anyway, that's my concerns. I have no idea what I'm going to do with this stock. They're reporting earnings, I think, in the next week or so, and I can guarantee you one thing. I think it's going to be volatile. It's either going to be way up or way down, and I'm torn on whether or not I want to start a position. I'd love to know what y'all think. Let me know in the comments. The comments are great. It helps me. It helps everybody else. It makes me want to do more videos. Keep it up. I'll see you next time.